Hello, everyone. So today we are going to talk about how you can begin leveling up as an investor. Now, today's live is for anyone who is investing in the stock market, whether it's through a 401k, an IRA, or a traditional brokerage account. Now, when we talk about leveling up, what I mean is taking investing seriously and being more intentional with how you decide what stocks to invest in versus what not to invest in. For many people, they tend to invest in the following ways. They go off of name recognition, meaning these are companies that they know, that they use, they see on TV, right? They also decide on investing in stocks based on random picks from the internet or hearing what their friends, families, and colleagues are investing in. Now, while all of the things I just mentioned aren't horrible ways to invest, we want to take it to the next level and be more intentional. So, what I like to recommend is to have an investor checklist. And what that is essentially 3 to 5 metrics that you are going to look at before you decide whether or not to invest in a company. So the one example I like to use is that of applying for a job. When you think about applying for a job, they don't just hand you the job just because of who you are, right? They vet you as a candidate. So they look at your resume, they'll bring you in for a couple of interviews. They may also do background checks, they'll ask for references. And then if you meet all of their requirements, then they go ahead and offer you the job. So you should think about using your investing and in a very similar fashion, or go about investing in a very similar fashion. So you want to vet these companies before you invest in them. And how do you do that? So again, you want to decide on 3 to 5 metrics to say, this is going to be what I need to see from this company before I hand them my money. Because that's essentially what you're doing as an investor, right? You're taking your money, you're handing it to a company to then say, yes, I believe in you. I'm handing my money. I want to invest in you. So they have to prove to you as an investor that they are worth you investing in them. Now that might sound kind of crazy because these are big name companies like Amazon and Google and Tesla, right? Whatever companies you're looking to invest in, but you must take investing your money seriously because it is your money, right? And you work really hard for it. And if you're investing in your future, you have to trust the company that you are handing your money over to. So you want to really think about what is important to you as an investor, again, before you hand your money over to these companies. So there are many things you can look at as an investor. As I mentioned before, you can make it as simple or as complicated as you want it to be, but you have to find a way to vet these companies before you hand the money over to them. And the reason for that is this is your money. You want to make sure that you are doing your due diligence before you invest in a company. So what should you look at? Great question. So there are a number of things you can look at, but here are some examples of what you can add to your checklist. So one, you want to see, well, how has this company performed over a period of time? So you could look at their revenue, right? So revenue is essentially how much this company has made in sales over a certain time period. It could be over 2 years, over 5 years, over 10 years, whatever you want to look at, you determine that. But you want to go back at least 2 to 3 years to see how have they performed. Are they doing well? Are they not doing well? Right. So that's one thing you could look at. Now, one place I like to go to do research is Yahoo Finance. This is not sponsored, by the way, but they have a very user friendly platform that you can use to do your research, whether it's on the internet, on the website, or in the app. They're both very user friendly. So you can look at their revenue performance. You can look at their stock performance, right? How has the stock performed in the last 2 to 3 years? So you are going to want to see the stock price increase. And if there is a decrease, you then want to understand the why. So, for example, during COVID, every company during COVID saw a decrease in their stock price. But since then, many companies have seen their stock prices increase, so they've rebounded, while other companies have seen their stock price decrease and they're still struggling. But again, you want to understand the why behind the increase or the decrease. So those are 2 metrics: revenue, stock price. The next thing that might be important to you is dividends. Does this company pay a dividend? Yes or no? Now, why are dividends important? They are important for a couple of reasons. Usually, a company can only pay dividends if they have enough cash to do so. So, if a company has enough cash to pay dividends, that usually means they are performing well and they can afford to pay you as a stockholder. So, dividends is a way for a company to reward you for investing in the company. Now, dividends can be paid out monthly, quarterly, annually. They all come in different cadences. But if a company can afford to pay dividends, that's usually a good sign. You will see some companies that didn't pay dividends. Now they started to pay dividends, such AKA Meta, right? I want to say Meta began paying dividends in 2023 or 2024. You have companies like Delta that used to pay dividends. They stopped paying dividends. Now they've since resumed paying dividends, right? You have companies like Disney who used to pay dividends. Now they've since stopped. Not sure when they're going to resume, but you have many scenarios of when companies pay dividends and some companies that will never pay or have not paid dividends, like Tesla. So again, that could be a good metric for you to look at as an investor to see if they can afford to pay dividends. They might be worthwhile investing in. Also, dividends is a great way to bring in income as an investor as well. And in next week, I will talk about investing strategies, so you can learn more about that. So make sure to tune in. But again, if you want to focus on income stream, dividends is a great way to do that. So these are just 3 metrics that are examples of what you can look at as an investor. But the whole premise of today's conversation is you need to have something you're looking at before you invest in a company. Too many of us are blindly investing and it shows, right? You're kind of guessing, you're kind of winging it, you're just kind of hoping for the best. And while investing in itself is great, it's good that you are able to do so financially, but you kind of want to go from there to that next level to where you're putting more intention behind the choices that you are making towards your financial future. So if you currently have a portfolio, for example, now is a great time to look at what you actually have and do you understand what you are actually invested in. So they have a 401k, an IRA, or any kind of regular brokerage account. Now is the time to understand, well, what are you invested in? Do you know why you chose these investments? Do you still believe in these investments? You might be surprised as to what you have, and you might be surprised at what you don't have in your portfolio. So again, this is the time to really take inventory of what you have going on and then decide, well, do I continue to buy these investments or do I try to invest in something else? Now, I'm not saying to stop investing in the things you currently have, but you may want to decide what other things should you invest in that you're not currently. And the best thing to do to kind of help you with that is to learn more about the stock market in general. Now, again, you don't have to learn everything all at once, but try to learn a little bit each month, each year, each day to then help you navigate investing. So the biggest thing you're going to want to focus on is investing terminologies. And yes, there are quite a few, but you definitely want to understand the basics, right? So think of like dividends, as we mentioned earlier, that's where a company gives you a portion of its profits as a shareholder, right? Then you have dividend yield, which is like a formula, very simple formula. You take the dividend divided by stock price, that's your dividend yield. Now, dividend yield helps you understand how much this dividend is in comparison to the stock price, and then comparing companies against each other. That's what a dividend yield will help you understand in regards to how well is the dividend, well, how well is this company paying dividends compared to another? Because not all dividends are the same. So one good example is Apple. So Apple currently, their stock price is about $200 per share, but they only pay about $1 worth of dividends for the entire year. Versus a company like AbbVie, this ticker symbol is ABBV, their stock price is also over $200 per share, but they pay almost $7 worth of dividends for the year. So as you can see, the stock prices are comparable, but the dividends are not. So dividend yield is kind of one of those things that you want to pay attention to help you compare dividends from one company to another. You also have things like revenue, balance sheet, right? There's so many things you could look at when it comes to investing in the stock market. But ideally, you want to understand a few basic terminology so you can really understand when you're watching the news, for example, what does this mean? What does that mean? Right? They might say the S&P 500 is up 500 points. What does that even mean? Right? There's so many things when it comes to stock market investing, but understanding the basics will really help you navigate investing in general. Now, going back to your investor checklist. So again, 3 to 5 metrics, and then that can change, right? Over time, as you become more sophisticated as an investor, your needs and wants will change as well. So your checklist may also change. So for example, right now you might only care about revenue, stock price, and dividends. Those are your 3 metrics. You only care about these 3 things, and that'll help you determine what to invest in versus what not to invest in. And then as time goes on, you might care about how much cash the company has on their balance sheet, right? You might also care about earnings per share, right? And there's so many more things you can add to your checklist. But again, you want to have a baseline to help you understand whether or not this company meets your requirements. And yes, you as an investor need to have standards and requirements. And I think it probably sounds kind of weird for us to say that, because you might say, well, it's just me. I'm only investing in a few $1,000s. My money doesn't matter. What I need or what I want doesn't matter, but it does, right? This is your portfolio. It's your money that you're working for. So you must have standards and requirements. So that way you're investing in companies that you believe in. And more importantly, you actually understand what they do. I've seen so many people who are investing in things that they do not know, do not understand. They're just guessing because of a tip, a recommendation, or they saw something online and they figure, well, I'm going to do it too. Now, can you make investments like that? Of course. You can definitely have things where you're investing, you're taking a chance. That should not be your entire portfolio. So if your portfolio is 100% of a pie, maybe 10% can be investing in things that are risky, you're kind of guessing, you're not really sure. That's totally fine, but that should not be how you invest all of your money, right? You don't want to approach investing in a way as going to the roulette table at the casino, right? You can't be gambling all of your money away. You want to invest intentionally, and then also have a small piece, if you so choose, where you're taking a bit of a risk or a bit of a chance. But it shouldn't be what you're doing with your entire portfolio. I know that many people feel as if that feels though they're behind. They feel as though they need to catch up. So they find themselves in a place where they're trying to take more chances. They're trying to be a bit more risky in the hopes that that money will pay off and help them get further ahead. And I understand that thought process, because you're kind of desperate in trying to catch up to get where you think you need to be. But I promise you, there is no fast track to building wealth. There isn't. Besides hitting the lottery, there's no fast track to it. Now, can you be a bit more aggressive in your investments? Absolutely. But again, you have to be intentional and strategic when doing that. And when I say be a bit more aggressive, it might mean investing more of your income in order to help catch up. You can also invest in more riskier investments, but again, it cannot be a gamble. You need to approach it in a way that you're being intentional, you understand what you're doing, and you're constantly reviewing your investment to see if you need to make any changes. That's the other piece of leveling up that you have to take seriously. Investing cannot be where you're setting and forgetting it. That's not how you approach it. You must constantly check on your investments to understand what is going on and if you need to make any changes. And those changes could vary. It could be you need to invest more money. You need to stop investing in certain things and pivot and shift to something else. It could also be you might need to sell certain investments because they're just doing that poorly. But again, you won't know that unless you're checking on your investments on a regular basis. I've seen so many people who have these 401ks, these IRAs, and they're kind of just throwing money into these investments and they don't look at it. They might look at it once a year because they have to do something for work. But outside of that, they're not looking at it. And that is a very dangerous game to play. Now, do you need to look at your investments every single day? No. But you need to get into the habit of checking on them on a regular basis. I would say if you can check on your investments once a month, that's great. If that is too much, then at least once a quarter. And during this checkpoint, you want to understand, what investments are doing well, which ones are doing poorly. Are you well diversified? Do you need to increase how much money you are investing, right? That's the other component of it. And again, also pay attention to dividends. So when it comes to dividends, you normally have to decide yourself to have those dividends reinvested automatically. So whenever you receive dividend payments into your brokerage account, unless you select the option to reinvest those dividends, they're going to just sit in your cash account and nothing is happening with those funds. So you want to turn on that feature in your account. So now when you receive those dividends from those companies, that money will be taken and they will purchase more shares of that company. Now, again, you yourself must turn on that feature. It is not done automatically. So unless you do that, it's not happening. And so while dividends might seem like a small amount of money, it is going to add up over time. And so really take that seriously. So now you're going to help snowball your wealth building journey. So these are just small things that you need to look at. And if you're not looking at or paying attention to it, you're leaving money on the table. So let's just do a quick recap. So you want to start vetting these companies before you invest in them. You want to make sure you understand what's going on with your money on a regular basis. And you want to be more intentional with the choices that you are making when it comes to what you are investing in. And also, you will have times where you might need to divest. Right? Divesting isn't a bad thing, but you can't divest just because you're panicking. Right? A lot of people will start to see a certain stock go down in price. They panic because they're losing money and then they want to sell. That's not always how you should approach whenever you see a stock price going down. You want to understand the why, right? The why is going to dictate everything, right? So if a stock is going down in value, maybe they just had an earnings call. They didn't do too well this last quarter. So the stock market didn't respond well, hence why the stock price is going down. Now, instead of selling, that might be the time to buy more, right? I like to look at things like that as a Black Friday sale. You're buying the stock on clearance, essentially. Now, is that always what you should do? No, but you want to do your research beforehand. Do you believe in this company? Do you think this is just a short-term dip and they might bounce back, right? That's also a possibility. But understanding the why is going to help you navigate whether or not you should continue investing in this company or not. But always make sure you are doing research and not just reacting on emotion, because the emotional investing is what's going to cause you to lose a lot of money or miss out on earning a lot of money. And so you want to take the emotions off the table and look at what are the numbers telling you, right? Numbers do not lie. The numbers will help you understand what is going on and how to move forward. So going back to my example where our stock price is going down, the why matters. Are they close to bankruptcy? Then maybe, right? That might be a good time to sell because the company's going out of business. But if it's not that, you must really understand, and it does require research, right? And that's the piece that most folks don't want to do because it's time consuming. But again, it goes back to it's your money. And again, no one's coming to save you. So if you're not willing to take the time to do a little bit of research, then you're going to get what you're going to get. So really think about approaching and investing in a way that it's a bit more serious, right? You're taking it serious because it's your money and you want to see benefit. You want to see a great ROI. And or to see that, you yourself have to put in the effort to make your money work for you in a way that's going to be conducive to reaching your financial goals. So that is it for today's live, guys. I'll be back next week. I believe next week's topic is, hold on, let's see. Investing strategy. So we'll talk about next week 4 strategies that you can consider as an investor. Now, depending upon where you are in your journey, 1 or 2 or all of those strategies may apply, but we will talk about them in detail so you can see which ones apply to you now and which ones you can consider for future use. So make sure to tune in to next week's live and I'll talk to all of you next week. Take care.